Have a quick look at MBOs and the tax opportunities that you can potentially get from looking at an MBO. You may recall from the last one of these we looked at the subject of valuation, so a quick recap on those just as a bit of a refresher. A business valuation is going to be based on 100% of the shareholding. Discounts will sometimes apply for minority shares. The valuation will be a debt and cash-free valuation. The valuation measure will be EBIT or EBITDA. Now that's variable depending on the business, and we will then adjust for exceptional items. So onto the subject of MBOs. Firstly, what is an MBO? Well, principally it's the purchase of the business by the management. I've put management in inverted commas, we'll touch on that a little bit later. It's usually funded with external financial backing, banks or venture capitalists. There is risk, but they can be beneficial to both current and future owners. And it doesn't have to be management, that's coming back to the management points up there. It can be family, extended family, it can be other partners within the business. It doesn't have to be management specifically. Management's just the broad sort of hat that we give it. When is it sometime you might want to consider an MBO? Partial or full retirement. Very often we'll find people who are coming up to retirement, want to get out of the business but don't want to become completely hands-off, so they might want to retain some involvement. Sale of a non-core subsidiary, so you might have a separate ancillary business that does a few bits and pieces that you've got a manager in place and you might want to relinquish control of that one. No option for a trade sale. Trade sale is just basically the term for an open market sale, an independent person coming and buying your business. Sometimes for whatever reason, it might be the sector you're in, it might be the market conditions at the time, that one's not an option. Succession planning, that's going back to what we talked about earlier in terms of getting the children involved, getting relatives on board and things like that. And quite a common one, conflicting shareholder interest. Basically that's going to be where you've got two or more shareholders, don't necessarily agree with the direction of the business. There's a potential there to look at an MBO to move things forward and either take one of the persons out of the business or potentially split the business in some way. In terms of how an MBO works and its structure, broadly this is how it's done. The existing management will incorporate a new company. This company then purchases the shares of the existing company, and then the old company trades as normal. What then happens is the old company will then remit dividends to what we would class as a holding company, and the holding company then can pass on the dividends to its shareholders, being the new management team. It's a share sale if it's done that way, so there are no VAT implications, but there are potentially some stamp duty implications in that transaction. Just thought it'd be worth their while looking at the differences and how the asset and share sale is different. Very often we'd want to go down the share sale route for an MBO, as it's a little bit cleaner, but there are some benefits to doing things one way or the other. If we're looking at a share sale, basically what happens there is the whole legal entity is sold. You buy the entire share capital of the business, the new owner takes on all of the assets and all of the liabilities. And it's a transaction between the buyer and an individual. I say individual there, it may be a company in the case of a company holding the initial shares, but as a general rule, the individual or individuals will hold the shares and the acquirers will buy them from the individual. If you're selling assets, it's the company that owns the assets, so that's a transaction between the buyer and the company. The pros and cons of each. Generally, a seller will prefer to sell shares and buyers prefer to buy assets. Why is that? Well, asset sales tend to be quicker, they tend to be a little bit easier, there's less due diligence required, it's quite easy to value an asset, it's based on its open market value. There are potential tax advantages to the buyer if we're looking at an asset purchase. You may buy a ream of assets, some stock, some machinery, some plant, and you might be able to classify those assets slightly differently for your own tax purposes. Share sales are a cleaner transaction though, in the sense that it's a one size fits all, it's a complete wrap up, everything moves across. Just a little point that is possibly of interest is that not all assets are necessarily transferable. So things like Amazon and eBay accounts and even things like social media accounts can't actually be sold under the bracket of assets. You would need to go for a share sale if you were looking at those types of things. And quite often now, internet presence and social media presence does have quite an intangible value to a business. If we look at how an asset sale would work, so we've got the balance sheet here of ABC Limited, that's at the 31st of March 2019. So assets, stock, debtors, cash, total assets 90,000. We owe out 30,000, share capital 100, so we've got the reserves of 5,900. You can see we both balance on there. So taking that, we have to remember, if we go back to the valuations, that the balance sheet isn't a reflection of profitability. So that net assets value, that's not actually what the company's worth. So the EBIT of this company is £75,000. Now, XYZ Limited has decided it wants to buy the assets for 4 times EBIT, which is the profit multipliers that again we looked at in the valuations exercise. And that buys them on the 1st of April 2019. So what is it actually buying? Well, it's buying the assets. It's buying the fixed, the stock and the debtors. But it's paying £300,000. So we've got that magical goodwill figure in there, the balancing figure. Let's assume that that transaction has now taken place. ABC Limited's balance sheet would look like this. Well, it's no longer got any assets other than the cash. We've been paid 300,000 and we had 10,000 before. What sits on the bottom? Well, we've still got the same liabilities because we've not transferred those. We've still got the share capital because we still own them. And we've now got a significant amount of reserves because that profit on disposal of the goodwill, that's a taxable profit that the company's generated by selling its assets. If we compare that to the share sale route, this is one of the reasons why it's often considered to be a cleaner option, is ABC Limited's balance sheet is exactly the same. What happens if we sell the shares? It's exactly the same. Why is it exactly the same? Because the acquirer has acquired the share capital, which means that it's acquired all of the assets and all of the liabilities. Now, nothing has changed because the company hasn't sold anything. In this instance, the individual has made the sale. Now, why is that a potential benefit to the individual? Entrepreneur's relief. It's one that our clients talk to us about a lot. It's available to you when you sell your shares in a business. There are certain criteria that have to be met. It needs to be a trading or holding company of a trading group. It needs to be a personal company. You need to be an officer or an employee. And you need 2 years of all of these criteria prior to the date of disposal. Why is it a good thing? Because the tax rate is at 10%. So you can see the share sale route does offer some fantastic opportunities in terms of mitigating your tax liabilities and getting profits out of your company. Thanks for watching. If you'd like to get in contact or have any further queries or questions, then please use the links below.